Most people who are just beginning their investing journey often come across two very popular terms: index funds and ETFs. Many beginners feel confused about whether these two are the same thing or completely different. In the previous video, we already explained what an index fund is in great detail. Today, we are going to spend a lot more time exploring ETFs, what they are, how they actually work, how they compare to traditional index funds, and which option is generally better for someone who is just starting out in 2026. Hello everyone, welcome back to the channel. If you are new here, please subscribe and turn on the notification bell so you don't miss any part of this beginner investing series. We are going step by step, starting from the very basics. In video 1, we covered index funds thoroughly. In this longer video 2, we will answer one of the most frequently asked questions. What is an ETF, and how is it different from an index fund? Before we begin, here is the usual disclaimer. This video is for educational purposes only and is not financial advice. Investing always carries risk, and you should do your own research or speak with a licensed financial advisor before making any decisions with your money. Let's start from the beginning. ETF stands for Exchange Traded Fund. At its core, an ETF is a type of investment fund that holds a collection of assets, most commonly stocks, and is designed to track the performance of a specific market index or a particular sector of the economy. In many ways, it is very similar to an index fund because both are passive investments that do not try to beat the market by picking individual winning stocks. Instead, they simply try to match the returns of the index they follow. However, there is one major difference that completely changes how people use them in real life. Traditional index funds are structured as mutual funds. They can only be bought or sold once per day, and the price is determined after the stock market closes. On the other hand, ETFs are traded on the stock exchange throughout the entire trading day, exactly like individual stocks. This means the price of an ETF can go up and down minute by minute while the market is open, and you can buy or sell it at any time during trading hours. To help you understand this difference more clearly, let me use a simple analogy. Imagine you want to buy a fruit basket that represents the overall market. With a traditional index fund, it is like placing an order with a store in the morning. The store prepares your basket and delivers it to you at the end of the day at a fixed price. You cannot change your mind or get it earlier. With an ETF, it is more like going to a busy market where many people are already trading fruit baskets throughout the day. You can walk in at 10 a.m., buy one at the current price, or even sell it at 2 p.m. if you want. The price changes depending on supply and demand during the day. This ability to trade at any time during market hours is one of the biggest advantages of ETFs and is the main reason why they have become so popular among both beginners and experienced investors. The history of ETFs is also worth knowing. The first ETF was launched in the United States in 1993. It was called the SPDR S&AMP P500 ETF Trust, and its ticker symbol is SPY. At that time, it was considered a groundbreaking invention because it allowed regular people to easily own a diversified portfolio of the 500 largest American companies with the same convenience as buying a single stock. Since 1993, the ETF industry has grown enormously. By 2026, there are thousands of different ETFs available, covering almost every market, industry, country, and investment style imaginable. Now let's compare index funds and ETFs in much greater detail across many different aspects so you can make an informed decision. Similarities. Both index funds and ETFs are passive investment products. They do not have expensive fund managers trying to pick winning stocks. Instead, they simply follow an index. Both provide excellent diversification. When you invest in a broad market index fund or ETF, you instantly own small pieces of hundreds or thousands of companies. Both have very low costs compared to actively managed funds. Both have historically delivered strong long-term returns for investors who hold them patiently over many years. Key differences. 1. Trading flexibility. ETFs can be bought and sold on the stock exchange at any time the market is open. The price changes throughout the day. Traditional index funds can only be bought or sold once per day after the market closes. 2. Minimum investment. Many traditional index funds require a minimum investment amount, sometimes $1,000, $3,000 or higher. ETFs usually have no minimum. You can buy just one single share. 3. Expense ratios. Annual fees. Both are cheap, but ETFs often have slightly lower expense ratios. For example, the Vanguard S&AMP P500 ETF VOO charges only 0.03% per year. This means you pay just $3 per year for every $10,000 invested. 4. Tax efficiency. ETFs are generally more tax efficient than mutual fund index funds. When you sell shares of an ETF, it usually does not create taxable capital gains for other investors in the fund. This advantage is especially important if you are investing in a regular taxable brokerage account. 5. Liquidity and trading costs. Popular ETFs have very high trading volume every day. This makes it easy to buy and sell large amounts without significantly affecting the price. Traditional index funds do not have this intraday liquidity. Let me give you some popular and highly recommended ETFs that many beginners consider in 2026. VOO, Vanguard S&AMP P500 ETF tracks the 500 largest U.S. companies. VTI, Vanguard Total Stock Market ETF, gives exposure to thousands of U.S. companies of all sizes. VXUS, Vanguard Total International Stock ETF, provides exposure to stocks outside the United States. QQQM, a lower-cost version of the popular NASDAQ 100 ETF, focused heavily on large technology companies. Now let's talk about when you should choose an ETF instead of a traditional index fund. You should consider ETFs if you want the flexibility to buy and sell during market hours. You are starting with a smaller amount of money. You are investing in a taxable account and want better tax efficiency. You like using advanced order types such as limit orders or stop-loss orders. You want access to more specialized or thematic ETFs. You should consider traditional index funds if you prefer simple, automatic monthly investing without watching market prices during the day. You are investing inside a retirement account such as a 401k or IRA. You value simplicity and do not want to deal with intraday price movements. Many experienced investors actually use both types depending on the account. They might use ETFs in their taxable brokerage account and use low-cost mutual fund index funds inside their retirement accounts. One concern many beginners have is whether ETFs are riskier than index funds. The answer is no. The investment risk comes from the underlying assets the fund holds, not from whether it is structured as an ETF or a mutual fund. A broad S&AMP P500 ETF has almost the same risk level as a mutual fund that tracks the same index. However, there is one behavioral risk that comes with ETFs. Because they trade like stocks all day long, some beginners become tempted to check the price constantly and trade too frequently. This frequent trading often leads to poor results over time. The best strategy for both ETFs and index funds remains buy and hold for the long term. Another important factor is how fees affect your long-term returns. Even small differences in expense ratios can add up to tens of thousands of dollars over 20 or 30 years because of the power of compounding. That is why choosing very low-cost options like VOO or VTI can make a meaningful difference in your final wealth. ETFs are also known for high liquidity. Major ETFs like VOO and SPI have enormous daily trading volume, which means you can buy or sell large quantities without the price moving against you too much. There are a few things to keep in mind with ETFs. During periods of extreme market stress, the trading price of an ETF can sometimes temporarily move away from the actual value of the stocks it holds. This is called a premium or discount. For large, popular ETFs, this situation usually corrects itself very quickly and is not a major problem for long-term investors. To summarize the most important points from this video, an ETF is an exchange-traded fund that tracks an index but can be bought and sold on the stock exchange throughout the trading day. ETFs generally offer more flexibility, often lower costs, and better tax efficiency compared to traditional mutual fund index funds. For most beginners, both options are excellent choices. The best one for you depends on your specific situation, the type of account you are using, and how much money you have to start investing. The most important factors for long-term success are not whether you choose ETF or index fund, but that you keep your costs low, invest consistently, and stay invested for many years. In the next video, we will discuss why most beginners should put the majority of their investment money into index funds and ETFs, and we will look at practical examples along with common mistakes to avoid. If this video has helped you understand ETFs and index funds better, please give it a like and subscribe to the channel. It really helps us continue making these detailed videos. Also, leave a comment below and share your thoughts. Are you currently using ETFs, index funds, or both? Which one are you more interested in after watching this video? Thank you very much for watching all the way through. I will see you in the next video.